Welcome to this explainer. Look, we've all driven past those old, tired, roadside extended stay hotels. But where most people just see an outdated building, a sharp developer sees a massive opportunity. Today, we're putting on our financial analyst hats and digging into a highly rigorous tool, the PRI Consulting Framework. We are going to find out exactly how analysts break down the feasibility of converting these hotels into lucrative apartment complexes.
So, what's our mission here? Well, it literally all boils down to one powerful concept: revenue arbitrage. In this framework, analysts aren't looking to, build from the ground up. They are hunting for hidden value. It's all about capitalizing on the valuation spread. Basically, we're comparing what a property makes right now as a transient hotel against the much higher value potential it could achieve as a permanent market-rate apartment building.
To figure out if an asset is actually feasible to convert, an analyst has to stress test the property using a strict 5-part diagnostic journey. We'll be looking at market economics, zoning and regulations, the housing deficit, physical infrastructure, and finally, the final checklist. Let's dive right in.
All right, Phase 1, market economics and revenue arbitrage.
This first phase, it is purely about the money. On one side of the equation, you have your traditional transient hotel metrics. We're talking average daily rate, or ADR, and revenue per available room, RevPAR. On the other side, you've got permanent apartment metrics, which are evaluated on annual rent per square foot. The analyst has to do a little math gymnastics here, converting those hotel metrics into a square foot basis to see if a value-add conversion spread actually exists. You have to prove that spread before spending another dime.
But here's the thing, we can't just guess that potential income, right? We have to rigorously benchmark our target against hard data. Analysts are looking for average effective monthly rents, auditing current occupancies, and analyzing 3-year rent growth trends. And they keep their focus incredibly tight. We're talking a strict 3 to 5 mile radius, specifically zeroing in on Class B, workforce, and micro apartment comps.
The absolute crucial point here is targeting the right submarket depth. We're looking at workforce housing, specifically households earning between 60 to 120% of the area median income. An analyst has to compare this exact tenant demographic against the existing garden-style supply in the neighborhood. Because, think about it, if there isn't enough demand from this specific income bracket to actually fill your new units, the whole revenue arbitrage model just collapses.
Which brings us to Section 2, Zoning and Regulations. Time to navigate the local red tape.
So, even if the math works out perfectly, you still have to deal with the local government. Analysts have to map the path of least resistance to legally put people in these units permanently. The holy grail is by right, meaning residential conversion is explicitly permitted, lowest resistance. Then you have moderate resistance, which requires a conditional use permit or a CUP. And finally, the highest resistance, and the one that kills a lot of deals, is a full rezoning. Basically, you need to know, are we allowed to do this by right? Or are we signing up for a grueling, multi-year political battle?
You also have to look out the window at the asphalt. Hotels and apartments have very different parking requirements. An analyst must compare the asset's existing parking stall ratio against the municipality's residential parking code per unit, usually breaking it down by studio versus one-bedroom requirements. We are quantifying any spatial deficit here. If the city requires 2 spaces per apartment and your hotel only has 1 space per room, ouch, that's a major regulatory hurdle that forces the developer to beg the city for a parking variance.
Furthermore, this whole mathematical equation exists in a political reality. A massive, often totally overlooked concern for municipalities is the loss of the transient occupancy tax. That's the lucrative hotel tax collected from short-term guests. Analysts have to weigh a city's fear of losing that juicy tax revenue against their desperate need for workforce housing. Knowing the local political precedents on adaptive reuse is absolutely vital if you want to predict asset feasibility.
Moving on to Section 3, Housing Deficit and Product Alignment.
Okay, so we need to ensure the local market demand will rapidly absorb these new residential units. Analysts dig into municipal housing element reports to quantify the local unit shortage. But it doesn't stop there. They also aggressively audit the competitive supply pipeline. They're looking at all active multifamily projects within that tight 3-mile radius, categorizing them by price point. The goal is simple: ensure you aren't building into an incoming supply glut that will just crush your projected rental rates.
And we really have to honestly evaluate the physical product we're offering. Extended stay hotel layouts are essentially micro footprints. They're typically 300 to 550 square feet with in-place kitchenettes. The analyst has to step back and determine, hey, do these tiny floor plans actually align with local renter preferences? They figure this out by looking at historical vacancy rates specifically for micro and small footprint units in that exact area.
Next up, Section 4, Physical Infrastructure and CapEx Diagnostics.
Now we're getting our boots on the ground. Can the building physically and financially handle this transition? Analysts perform a rapid-fire audit of major physical and contractual hurdles. Are the utilities master metered? If so, how much is it going to cost to sub-meter electrical panels for individual tenants? And what about unexpired hotel franchise agreements? Analysts actually have to calculate the exact liquidated damages for dropping the hotel's brand flag. These are hidden costs that, if you overlook them, could literally bankrupt a project before it even starts.
Then there is the ultimate physical hurdle, the code transition itself. Hotels operate under a transient R1 use code, while apartments operate under a permanent R2 residential use code. Analysts must calculate the exact, down-to-the-penny cost of upgrading life safety systems to make this jump. We're talking inspecting fire suppression systems, checking if sprinklers are in-room or only out in the corridors, and ensuring egress paths meet the strict permanent residential codes.
Finally, we hit Section 5, the final checklist and municipal pre-app.
After successfully navigating the economics, the zoning, and the physical infrastructure, analysts arrive at the culmination of the journey. During initial due diligence, you must definitively answer 4 questions with city officials. 1. Does the zoning designation actually allow permanent residential occupancy? 2. Will the city accept existing parking, or is a formal variance required? 3. What specific building, fire, and energy code triggers occur when switching from R1 to R2? And 4. On a positive note, are there local tax abatements or adaptive reuse incentives available? You absolutely need these answers to ensure your calculated arbitrage isn't actually just a regulatory trap.
By following this strict analytical framework, real estate professionals can uncover incredible value while providing some much-needed workforce housing. It really requires a meticulous blend of financial modeling, regulatory navigation, and physical inspection, which leaves us with a fascinating thought to end on. As the municipal workforce housing deficit continues to grow nationwide, how many underutilized assets sitting in your own city are just waiting to be mathematically unlocked?